This is the daily fiscal pulse for the 9th of June, 2026. What you're about to hear is a one-day look back into the flows as of Tuesday's close. It's not a live read, so keep that timing in mind as you work through this. Let's set the stage first. The market mood right now is anchored around one central theme: no clear dominant narrative. That headline about Wall Street needing a crash course in the token economy ahead of AI IPOs, with SpaceX offering a preview, is the narrative du jour. It's clearly moving price action, but as always, we need to dig past the headlines and see what the actual flows are telling us. The headline number for today is $8.0 billion in net fiscal transfer. That's solid on the surface. The real story, though, is what's happening underneath. The 5-day flow has decelerated significantly, cutting roughly in half compared to recent levels. Tax receipts are carrying the load at $8.9 billion. You can see this playing out in the ES futures, which closed at 7,392. That's materially below the 20-day moving average sitting at 7,504. The broader band spans 385 points and the trajectory is clearly downward. So flows and price are aligned here, both sending the same signal. When you pull back a bit further, the picture sharpens. Government spending on a 5-day basis is averaging roughly $5.2 billion per day. Take that against the 20-day average of $15.8 billion. That's a meaningful deceleration. Fewer dollars are flowing through the system, less cash percolating through households and into asset markets. Financial conditions are contracting. The year-on-year comparison doesn't change much. Spending is essentially flat at $1,112.8 billion. There's no material uptick in fiscal support to offset what we're seeing. From a positioning angle, the fiscal backdrop isn't giving you an obvious directional edge at the moment. The conditions gauge is sitting at -14. But context matters here. We've encountered this setup repeatedly, and despite the weaker liquidity profile, the S&P has averaged around plus 1.6% over the following month. Liquidity and price movement don't track in lockstep. Markets can grind higher even when cash is tighter. Positioning adds complexity. Leveraged funds are paring back their exposure, and margin debt is at the 100th percentile, which is historically elevated. That level usually functions as a warning rather than validation. The practical implication is this: with fiscal flows running below year-ago levels, there's less cushion underneath the system. When headlines turn supportive, equities can still creep higher, but when a risk event erupts, whether it's escalation in the no clear dominant narrative, selling pressure can accelerate precisely because there's not enough liquidity underneath to prop it up. As we move forward, a couple of dates deserve attention. The 10th of June marks the SSA payment cycle, second Wednesday of the month, and that can shuffle the near-term flow picture. So fiscal drag is definitely showing up in the numbers. That said, the speed of tightening might be stabilizing. The next inflection likely hinges on how these scheduled flows actually materialize. That's your edge right now.